All right, good afternoon. Check, check, radio check. We'll go ahead and get started. Want to thank everybody for taking time out of their schedules to join us. If somebody wouldn't mind typing into chat that you can hear me, see me, everything's working from a technology standpoint, we'll go ahead and get started. And very good, very good. Thank you, Harold, Caitlin. All right, so in the spirit of September being Life Insurance Awareness Month, I wanted to just sort of, reiterate, part of my, what I've learned over my career. And, this is not life insurance is not, what it was when it first was designed and created. It actually can be viewed as, in my opinion, an asset class. And depending on what's going on in the market, it's a tool that when properly structured can achieve a couple different functions. So, I last week we talked about Kaizen and using leverage, and but that's not for everybody. But there are things that you can do and that you should understand how it works to maybe start to think about adding to your portfolio. So, without further ado, what makes life insurance so special? And it's these two sections of the tax code, 72E and 7702. So in my opinion, what I've taught for pretty over a decade now is that 72E, the most unique feature of permanent life insurance is that under this section 72E and 7702 of the Internal Revenue Code, the accumulation of cash inside the insurance contract is tax advantage. Not only can the cash value accumulate tax-free, but the cash can also be accessed tax-free. Hence the beauty and magic of life insurance. It's a unique vehicle that allows for tax-free account value accumulation, allows you to access your money tax-free, and when you die, it blossoms in value and transfers income tax-free. When you think about that, like I don't want to rush through that. I mean, this book right here is a whole book written on exactly that. So when I talk about um, life insurance, cash value permanent life insurance is the greatest gift that Congress has ever given the American taxpayer, but it's got to be properly structured. And so, part of this is it's in its evolution when finally we got here, why life insurance? So here's what everybody's been taught. So if you understand that I teach and I my clients, I help them to retire and to retire successfully. But as we're working in our accumulation years and even as we start to segue into retirement, there's this, theory, philosophy, and it's proven, but it's starting to become a little archaic, and that is that asset allocation, right? That put money into your 401k, your 403b, your TSP, and have a 60-40 blend, right? While you're working, maybe it's 70-30, you can afford a little bit more risk when you're younger. And then as you get older, maybe you shift it and dial it back to 50-50. And that's all during the accumulation phase. But really now one of the things that I've started to see and start to talk to folks about is see the reason that this always made sense is that these two asset classes are non-correlated or were. But we are starting to see that there is less of a delta or differentiation between the two asset classes. So when stocks go up, you used to think, oh, stocks go up, bonds go down, and vice versa, like a seesaw. That's not necessarily the case anymore. So, permanent life insurance as an asset class, intelligently designed and specifically index universal life insurance policies that are strategically funded by the policyholder. Typically, we suggest redirecting retirement tax deferred funding for this strategy. So, what's that mean in English? So, when we're looking for and starting to, once we say, hey, this is why it makes sense, and people understand where do the funds come from to put into this. And really in what we've been teaching and we've seen a lot of success for, it's redirecting away from the 401k. So remember, companies used to reward us because we would work there 20, 30, 40 years and we would get a pension. But as I always say, pensions nowadays are like unicorns. So then, hence the creation of 401ks. They really shifted the burden to the American population. Well, when that happened, most of us did not have training or understanding, and the theory was go ahead and put money in a tax deferred because when you get to retirement, you're going to be in a lower tax bracket. So all the things that we've talked about over the years. But what we've now found is that, we just hit $35 trillion in debt. We're most likely not going to be in a lower tax bracket. So by default, what that means in English, we've deferred all of the funds in our 401ks, IRAs, and 403 type plans, tax deferred plans, also known as qualified plans. We've kicked that can down the road, and the government it's non-sustainable. I just saw on CNBC today, it is non-sustainable. Everybody knows it now. They cannot get away from this. And so that means that our tax environment is going to be higher in the future. So we, by default, have deferred our accounts. We took the tax deduction while we were working because we were told or sold the bill of goods that we'd be in a lower tax bracket when we retire, when quite likely that is not true. Now, if you already hit retirement, you're already there. Probably there's not a lot we can do. Sometimes Roth IRA and Roth conversions make sense. But when I'm speaking with folks that are in their 50s, 40s, and 50s, and they're what we call high income earners or Henrys, high earners, not rich yet, right? So when you're in this, you have this money and I just had a client last week I was talking to, and she's in catch up. She's like dumping 30 grand a year into this plan. And I'm just going, if there was a better way. I mean, it's tax risk, it's taxes, it's the taxes, it's the taxes. We talk about that all the time. So what the reason I'm so passionate about considering life insurance as an asset class is all the other benefits that it affords us. So living benefits, right? So we get the cash accumulation. We can have terminal illness. It helps with critical illness or chronic illness. Long-term care hybrids. Hybrid long-term care insurances uses the death benefit to actually provide some type of coverage should we need to access. You can actually accelerate the death benefit to pay for custodial care, extended care, long-term care. And then you have the acceleration of the death benefit. So if you had that terminal illness or chronic illness, that's that acceleration that they can actually, one of my partners, the person was diagnosed with brain cancer, and he had sold this person a $2 million death benefit, and they were able to access that death benefit while they were still alive and spend the last 5 months of their life enjoying the family, celebration of life. There's different ways to use this, but it really can be a benefit for the family. Death benefits paid to beneficiaries, income tax free. That's powerful. And here's where my mind goes a lot of times. I remember I had a doctor that he's since passed away, but I think we put about $1 million of death benefit. And I was doing this in 2007, 2008 with him. And I said to him, by you funding it this way, what you've in essence created, because he had a lot of money in qualified plans, right? These 401ks, IRAs. Remember, if you die with those funds still in qualified plans, IRAs, 401ks, 403bs, taxes have not been paid on that. So that burden, the tax man's going to come. And that as that gets deferred to the next generation, there are rules to start to accelerate the spend down. And quite often beneficiaries don't care about the taxes. So, you got $1 million in your IRA and I'm only 40 years old. And you know what? I'm just going to take it now because I want the money now. Somewhere around 40% will be the tax rate if they took it all at once. And that's in today's tax environment. If they raise the taxes in the future, it really will just cannibalize everything that folks have saved their entire life for. So one of the things that I've always tried to teach and share, when you have a max funded life insurance, and if you're not using it for income, a lot of times we'll use the life insurance for income, but sometimes we use it to what for lack of a better term, clean the IRAs or clean the 401ks. Basically, it's a permission slip to spend your money so that you, at the end of the day, your estate is now plenished to your heirs, to your beneficiaries, to whoever you want it to go to, income tax free. It's really, really powerful. And then waiver of premium. I share this because about 10 years ago, there was a client that, I was able to help both the husband and wife. And 3 years ago, she got long COVID. She has since, I didn't even know what long COVID was, but one of the things I always try and do on my contracts is put waiver of premium. And what we ended up doing, it's not just waiver of premium for the cost of the insurance, but sometimes you can put it on so it's waiver of whatever the scheduled premium was. And we had designed this for max funding for tax-free income. Well, I mean, I can't tell you how thankful that I was knowledgeable and how thankful she is that I was knowledgeable, because not only did she lose her job because of disability, she's fighting with Social Security because it's still an undiagnosed sort of classified illness. But the life insurance plan we have put in place, the insurance company will now continue to max fund it. So it really, really is something that it's a tool that I hope we never need it. But when properly designed, I really cannot think of a better tool that we need to have in our overall, in our financial house. So why index universal life? So IULs were first offered in 1997 by Transamerica, but it's seen tremendous growth over the last 27 years. Today, more than 40 IUL or insurance companies are offering some type of IUL policies. Now, there are companies I gravitate for. I offered in 25 years ago some of the early versions of this, and now I've seen nothing but improvements. They're getting better. And there are other types of insurance. I had a call last week with somebody and they said, oh, I got a whole life contract. Well, once he got me the document, it wasn't whole life, it was term. And I've talked before, gets confusing because we tend to substitute, words. And when he was conveying information to me, when you say whole life, that's a completely different product. Not bad, it's just different. But what he thought he had is not what he had. He actually had 15-year term, and it's actually lapsing or going up in premium next year. So diagnosing and figuring out what you have whole life is not really the best wealth accumulation or growth tool. It's actually a tool that I would only use for estate planning, right? And then there's something called GUL, Guaranteed Universal Life, or just regular universal life. Those products I'm not as thrilled with. Like GUL, I actually prefer to a whole life contract because the internal cost of insurance is less, and typically there's transparency. But ULs, I think that they got a black eye back in the late 70s, with Prudential, and everybody was running around saying, look at the rates of return. But what was missing there is that the crediting rates that these insurance companies were offering to the public were based or decided by the board of directors. And so because they were, they answered to stockholders, they systematically lowered the crediting rates. So what they started out in the first year said, look, we have 8% guaranteed in the first year, but within 10 years, that contract, they've lowered the crediting rate to 4%. So again, a lot of people don't trust insurance companies, and one of the things I've always said, there are no deals in the insurance industry. These are designed by actuaries and attorneys. But IUL, this is why I really, really, I'm a huge fan. Once you understand it properly structured, what we've done, or what this product has done, is remove the insurance company from the equation. Why is that important? because what they're doing is with their general account, they could have given you, say, in today's environment, 5%. They were going to keep 1%, so maybe they credit 4% in their fixed account. Well, instead of doing that, they're going to give you 0. You know, why is that a deal? Well, but with that option budget, that 4% that they could have given you, they go out and buy a call option on an index. So you're not in the market, and now you get to participate in returns on the upside with 0 market risk. And this is why, you know, I wanted to take a little time to really make sure that I explain that. So because once you understand how brilliant that is, and we've removed that insurance company risk from the equation, people, this is why there's such an abundance of growth in the industry on this. Here are primary advantages of these contracts: no market exposure, lock in and reset. I said rest there, typo. Flexibility, predictable rates of return, can be used for collateral, liquidity and control, tax favored outcome, and non-correlated assets. So it's starting to check a lot of the boxes. Now, the last thing I'm going to talk about it, and I shared this last week, and again, I know it seems very rudimentary, and you're like, I got it. This is one of the crediting methods. It's not always, but when I talk about a cap, sometimes there's products now with no cap, but it's called a participation rate. So, you know, as we start to get into, you know, which companies offer the best products, you know, I tend to lean towards certain companies. But in short, what happens is if the premiums go in, and typically we like to fund them as quickly as possible, get that cash in there and work. And then as it's going, right, the market's going to go up through that whole year. It's going to go up, it's going to go down. And so as the market goes up, anything within those 2 black lines, it's going to stay there. But if it goes above the cap, right, during the year, it can go below it. But as it finishes up the year, if the market continues, the S&P index in this example, right, it caps and locks in. That is critically important. That's not like your 401k. Hey, you're like looking at it and you're going, wow, yeah, I looked at my statement. We had double-digit returns, and then now we've had some volatility of late. And you're saying, well, I've lost 10 or 15% of where I was at. So this prevents a lot of that, and it allows us to design predictable rates of return. But not every year is a good year. And so when we turn around and you have years where the market starts to fall out, now you have comfort because we haven't given anything back, but it actually works to the benefit, because now when the market is down and the next premium comes down, you're going to engage in something called annual reset and lock-in. So this is another slide that's basically illustrating the same thing, but now it's going to really, this portion, if we had 100 grand and let's say I had 2 accounts side by side, both were match funded already, and let's say that the crediting of these accounts, let's say that the IUL had a cap of 12%, but the market only did 10%. So if we had these 2 accounts side by side, the 10% gain becomes 110. But now what happens is if you were in the market and the bottom dropped out, well, the 10% gain from the 110, now you've lost actually, and you're below what you put in, you're at 99. But somebody that was in an IUL that had no market risk, that moved right along. But not every year is going to be 10%. So the next year might only be 5%, but somebody in an index universal life is getting 5% from the new floor, which is 110 here, and finishes up with 115. Versus somebody now, after being in the product, turned around and get 5%, they're barely above what they turn around and put their money in. So this is a simple explanation of the advantage of annual lock-ins, but really where I think the secret sauce is, and this is what most people miss. Because as we're showing illustration rates, and right now, you know, I think we can comfortably say 6.5, 6 3/4 are approved illustration rates, right? That we can depend on year in and year out, long term, to be able to project what kind of income stream this might give us or growth factor onto the account. But the secret sauce, and hear me on this, not every year is going to be 6% or 7%. We're going to get zeros, but we're also going to get caps or participation rates. So what's that mean? So let's look at this number, 115,500. So 115,500, right? On the next slide, just say the index, the S&P was at 940, and your account had the funds in it at 115, 400 and or 500, and the bottom fell out. And that has happened several times in the last 20 years, right? So because of that, right, you've all seen your 401k statements, is that's where you save your money. Well, now when it turns around, the bottom falls out because we have no market exposure, the index will have dropped. In this example, almost 30% down to 650. Well, that 115.5 moves to the bottom. So that is locked in, and that's where the ball bounces from right there. That's where we get our gains from. So when it recovers, and the market over time has, and it will, it doesn't even need to get back to even. With the 10% cap, we turn around and it gets to 920, but now you're getting 10% on the 115,500. You're not digging out of a hole. This is the secret sauce right here. It's this annual reset from the contract dates that give us predictability and allow us not to have that exposure that so many people are going, well, I didn't know that was an option. Now, the only hang up here, you got to qualify. You have to be in good health. You have to be able to turn around, have time. So one of the things when I'm designing contracts, I tend to, my background, if you don't know, is mechanical engineering. And so one of the things I always try and teach is it's an order of operation. Once we've grown and have this account and it's all in this vehicle and it's all tax free, and I don't care whether it's a Roth 401k, or a max funded IUL, what I try and teach people is let's mitigate the tax risk. Let's go ahead and start to withdraw. Once we get past 59 and a half, somewhere, even if you're still working, maybe we're doing Roth conversions, maybe we're funding this, but let's stop loading the wagon on the 401k. Or actually, let's start to spend that down so that we're now, because RMDs are coming at age 73 right now under current law. So what this does is it helps us to disarm a ticking time bomb that most people have in their portfolio and they don't even know it. So I know I've spewed off a lot of information. This will be recorded. You'll be able to go back and watch it. But to me, this is what makes it so powerful. So, lastly, we're at that time of year where I'm doing classes again, rocking and rolling. Rutgers is allowed us, and we've already done 4 workshops this year. We have 2 more coming up the end of October and the beginning of November. So this all is complex. Claiming Social Security, organizing and coordinating your assets that you've accumulating, transitioning into retirement, Medicare, when should you take it? Do you have health? I mean, it's like, how do people do this if you don't understand it? And you cannot afford to make a mistake. So we're going to encourage you to come. I think I don't know if the registration link's been set up yet, but if you want to come, send me an email. I'll send it to Caitlin and Keith in my office. We'll put you on the list. Make sure you get invited. There's nothing sold there. This is purely educational, but you got to get this right. So for everybody on the call, I want to thank you for your time. If you have any questions, please reach out. Remember, September is Life Insurance Awareness Month. And at a bare minimum, you should be pulling out your life insurance contracts, looking at it and saying, hey, is this what I want? Is it going to expire or premiums going to increase? And is there anything you can do right now to improve your circumstances? We're happy to help, and thank you for joining us.